if instead of treasury bonds, you replace that 40% with commodities and went back to 1945, they show over that time frame that not only would the return have been better with 40% commodities instead of treasuries, but the drawdown would have been less severe, so less volatility. Now, we're not advocating to just buy and hold over this long period of time like this, but it does make a point that commodities can, especially during inflation episodes, be a very, very important diversifier, even a much larger allocation than kind of the token allocation that many investment advisory firms will suggest. Hello, everybody. It's John Llodra here. I'm a co-founder and partner at New Harbor Financial Group, here for our weekly market update and commentary. Thank you for joining me here today. The purpose of these videos are to bring data, our insight on that data, all for the purpose of educating and hopefully giving our clients and viewers a little bit more peace of mind and hopefully sleep-filled nights as relates to their financial situations. Wanted to kind of talk about a newsworthy event of sorts. This past Friday, today is Wednesday, the 22nd of May, 2024. On Friday, the Dow Jones Industrial Average, perhaps one of the most widely followed stock market indices because it goes back probably the longest in time, well, it crossed the 40,000 level on Friday, first time ever. Nice big round number, and 40K is a pretty headline grabbing event. So I want to kind of talk about that, just kind of the hype of that, and perhaps what it means for where we are in the market cycle. So this is a table that was put together by the folks at NASDAQ Dorsey, right? Their great data research service that we use. Basically what this shows is over the history since the early 70s anyways, the milestones of the Dow Jones Industrial Average surpassing or reaching around 1,000 point levels. One key thing that hopefully is pretty self-evident, but bears pointing out, from 1,000 to 2,000 way back in the late 80s, 72 to 87, that was a doubling, 100% return. This latest 1,000 point move from 39,000 to 40,000, that's just a 2.5% increase. So these big round numbers, while they're headline grabbing, they don't really mean much in terms of the magnitude of the move. In fact, this column here shows the power, if you will, or the rapidness of the recent rise normalized over the percent as a percent return over the prior 100 days. And you can see of all these milestones, the most recent 1,000 point milestone is amongst the least powerful. In fact, only 3% return, average return per 100 days. So kind of a nice headline, but kind of a dud in a sense. And in fact, if you look at the broad market, the Dow Jones has kind of been a laggard of sorts, certainly since 2023. Basically, this shows a ratio of the S&P 500, which also recently achieved all-time highs. But you can see the ratio here, when this is increasing, it means that the S&P is rising faster or more substantially than the Dow Jones. The only time in this chart that goes back to July of 2021, the only time that the Dow outpaced the S&P was during the sell-off in 2022 in the stock market. So interesting headline, but not a whole lot of really notable news there. This kind of begs the question, where are we in the market and where are we going from here? We can't help but always remind folks of where we are in the market cycle. This is a chart that shows the Shiller cyclically adjusted PE ratio in blue. This goes back to the 50s anyways. You can see here we're at a level of just over 33, way higher than we were right before the housing bust. Not quite as high in this measure as the peak of the tech bubble, but if you adjust for some things that are appropriate, like margins and things like that, we are rivaling valuations that have only been seen really 2 times. The peak of the tech bubble in 1929. The other line here is corporate profits, after-tax profits, as a percentage of GDP. You can see right now we're about 11%. Over history, that's averaged closer to 6%. Much of the reason we think for this elevated profit margin here is because of the massive amounts of stimulus and fiscal spending over the last bunch of years that has essentially transferred deficits at the federal level into windfalls, even, if you will, at the corporate level. We don't think that's sustainable unless for some magical reason we can keep sustaining the budget deficits that we have been, almost everybody on both sides of the aisle think has expressed it's unsustainable. Fed chair has expressed unsustainability. Treasury secretary, not really a likely scenario. So bottom line is we have a double jeopardy of sorts, near record high valuations combined with record high profit margins, when in fact that major bear markets in the past, like for example, the low in 1982, which was a generational low great time to be a stock market investor, we had both valuations and profit margins depressed. So we think we're ultimately going to get there at some point, but the market for the time being has been quite strong and bucking trend of these extreme valuations. Just another way of looking at the extreme valuations, this is a price to sales ratio for the S&P 500. Now, interesting here because earnings can be manipulated in all kinds of ways to look good on paper, if you will, but sales are hard to manipulate because they're top line. So a price to sales ratio is not susceptible to the same kind of manipulation that earnings can. So here we are at levels that rival where we were at the tippy top of the tech bubble. So very much an overvalued stock market. And interestingly, I just wanted to kind of this is a chart that shows Wall Street analyst predictions of where the market would end this year. The S&P would end 2024. Their predictions as of December 23 and this May. And you can see almost all analysts have moved their, the blue to the black dot have moved higher, but yet almost all the analysts still are predicting year end on the S&P that's below the current level of 5,300 and change. So interesting there. Notable here, one of the remaining bears on Wall Street, Mike Wilson at Morgan Stanley this week made headlines because he basically threw the towel in and said, you know what? My bearish outlook, I can't fight it anymore. And, it's kind of a cliche, but when prominent bears like that throw in the towel, it's a little bit, oftentimes can be a sentiment indicator that the market is nearing a top. We think this probably still has a bit further to run, but we do think this is a blow off top kind of market that will likely peel back quite substantially, especially given the valuation backdrop we just talked about. All is not bad here, though, because if you look at international stocks, they have been and remain at quite compelling discounts and compelling valuations relative to U.S. stocks. So the blue line is the U.S. cyclically adjusted PE ratio, and the orange line is the international. So you can see, we think a very compelling area longer term, and we've seen some certainly some strength in some international, especially emerging markets, that seems to kind of correspond with these valuation discounts. So I want to kind of take a break here and just kind of take a step back. Very overvalued market, but as we've talked about in recent weeks and months, the market has been tremendously strong, lots of momentum. You can call it psychology, emotions, whatever, but for whatever it is, the market has been quite strong. And in fact, there's been a broadening of the market from a very narrow market in most of 2023 to a very broadening of the market this year. We've seen many other sectors participate. We've seen stocks on lower market capitalizations start to participate more. And if you look at measures like the percentages of stocks on buy signals and the percentage of stocks above like the 50-day and 200-day moving average, these are all breadth indicators. They've all been quite strong and improving, and that despite the overvaluation speaks to a market that has lots of momentum behind it and a path of least resistance likely going higher, at least in the near term here. But we are seeing short term some extremes, some overboughtness, if you will. And I'll show another chart here that speaks to that. So this just shows kind of major market components. You've got gold here, you got emerging markets, you got broad commodities, you've got oil, you've got NASDAQ, S&P 500. And basically this shows the percentage overbought or oversold. Essentially in the middle of the road here is kind of neutral. When things get really oversold down here, it's highly likely we'd see some kind of snapback. When they get very far to the right here, very overbought, and we'd likely see a snapback. This is, I would call it, moderately overbought, so it's certainly not extreme. Interestingly, today after the close, NVIDIA reports earnings, and that stock single-handedly seems to have been ruling the world, and it would be no surprise to see whatever that stock does after hours on the earnings report really sway the market one way or the other. And it could go either way, frankly. I've kind of given up trying to forecast what's going to happen with NVIDIA earnings because there's a whole lot of noise there, and certainly the valuation is very expensive even for strong earnings. One area that we have seen recently some strength, and I want to kind of give a bigger picture view here, is commodities. This shows a long-term chart going back to the 90s of the ratio of commodities to the S&P 500. And you can see we're at multi-decade lows, meaning commodities haven't participated to the upside in the same way the S&P 500 has. Now, historically, this hasn't persisted down low. In fact, you can see here a very sharp bounce. So we think it's very likely that this chart will trend higher. And that can happen one of two ways. The S&P 500 drops, commodities rise, or a combination of both. And we think very likely it's going to be a combination of both. So we're very bullish on commodities, and we do have exposure, and they have done quite well. Interestingly, this chart was put out in the last week or so by Bank of America Global Research, and this is a chart that compares, bonds have been a really difficult spot the last bunch of years for anybody that's a bond investor. And no small part of that is the inflation tick up in interest rates, both of which are very unkind to bond investing. But this shows a hypothetical 60-40 portfolio. The traditional 60-40 is 60% stocks, 40% bonds. But what Bank of America did here is they simulated if instead of treasury bonds, you replace that 40% with commodities, and went back to 1945, they show over that time frame that not only would the return have been better with 40% commodities instead of treasuries, but the drawdown would have been less severe, so less volatility. Now, we're not advocating to just buy and hold over this long period of time like this, but it does make a point that commodities can, especially during inflation episodes, be a very, very important diversifier, even a much larger allocation than kind of the token allocation that many investment advisory firms will suggest. So this is a look at year-to-date performance of the various sectors of the economy. Interestingly, gold mining stocks have been the strongest performers, up just under 20% year-to-date. We have been long proponents of gold mining stocks and gold as well. Gold mining stocks we have considered quite undervalued relative to the metal. We still think it is, but they've had a nice catch up here and very strong. Second sector, boring utilities. We actually just put on a position a handful of weeks ago in utilities, and it's been, frankly, it's looked more like a tech stock the way they've been elevating. And that's a combination, I think, of the forecast for increasing demand of energy by data centers and whatnot, but also utilities got to be a bit oversold and unloved, and with some moderation of yields, the higher yields on these utility stocks have been compelling. So quite a nice run here. The only sector that really hasn't lost money year to date is the real estate sector. Probably no surprise to most viewers there, but really some strength in the commodities and materials point. And here's a interesting tweet I came across by Sentiment Trader. They're a great data shop that we follow. And basically, it says more than 40% of gold mining stocks hit a 52 high this past week. This is the first reading of that in over a year. And the last couple of times, as you can see here and here, marked early innings of a strong rally. So who knows if this will be the case? We do think this rally in gold miners does have further to run. Would not be surprised to see a near-term pullback. In fact, today they're pulling back a little bit. We actually sold call options on some of that position yesterday. So a very timely point to have done that, to bring in some income to offset pullbacks. But I thought that was a really interesting observation there that certainly bodes well for our allocation to gold mining stocks and commodities in general. Anyways, that's about all I want to cover here today. We're obviously watching things very closely, and we do think this market could start to turn on a dime, and we'll be watching for some of those indicators like breadth and momentum that I spoke of start to turn negative. And we do remain fairly conservatively postured, only about 40% in stocks. Big dose of short-term treasury bills, still yielding over 5% annual yield. And we do have some hedges in place. So if the concern we have about the broader valuations comes home to roost, we think we'll be able to weather that quite nicely for clients and still make progress, hopefully on the way, if we continue moving higher here in the short term. I want to thank you for watching. And again, please like and subscribe. Like this video and subscribe to our channel. Drop some comments or questions in the comments fields. And until next time, I wish you a great day and thank you for watching.